Someone on WhatsApp is asking for a link. Do one of you mind sharing the link with that person then? Because okay, thank you very much. Okay, so it's popped up on my side that it's being recorded. Okay, right. So let me just start sharing my screen properly one time. You guys just let me know if you can see my screen or not, right? And you can just confirm with me before I continue, because I don't want to be going on with the lesson and then you guys can't see what I'm doing. Okay, so just confirm with me that you guys can actually see my screen. Okay. Right, so I'm going to get started with the lesson, right? I'm just going to go through a brief overview, okay, on what we will be doing. So the introduction, welcome, the general admin. I'm not going to talk about all of this. I think you've heard enough about the bootcamp, and I don't think this is a priority for you guys today. So what we're going to do is, that shouldn't be there, right? IS2, IS16, 3840, and IFRS 16. These are your standards governing your assets. And these are largely what we're going to be focusing on, okay? The theory for these is quite important. I know a lot of you guys would have overlooked it, but the reason that I am focusing on it is because of the fact that when we actually mark papers and when we actually go through the way students have answered, you'd be amazed at how many easy marks get left behind just in terms of your costing, your question and things like that. And remember one thing, it's not the more complicated things that are going to get you. It's going to be the nitty-gritty things that you guys overlook. That's number one. And number two, it's going to be your question, and even in terms of answering theory questions on this, because theory, if, in case you guys haven't noticed, is becoming a very increasingly popular type of question. And you guys need to make sure that you are very comfortable with it. And I think at this point, a lot of you are just doing questions and hoping that, okay, I've done a question, I come right. That's, you know, pretty much the way you've been going through it. It's fine to an extent, but I don't agree with the whole thing of learning through questions, because it does be quite limiting, okay? And you'll see what I mean in a minute. Okay, so I'm going to start off these slides. I am going to go through quite quickly because you guys know the theory, and you guys will get a copy of the slides whenever it comes through now, or what I'll do is I'll create a Google link or Google Drive link, and then you guys can access it through there. The main thing in theory, right, and if you guys have your standards with you, it's important to have this, right, is, okay, this is self-explanatory, but this part over here, which says what inventories are, okay, because obviously they are for purpose for sale in the ordinary course of business, for use in the production of goods, or for rendering of services, right? This part here is where we find that during the tests, and even some examinations, students get confused in terms of the classification part of it. And this is often, you know, a good point for where an examiner can do a classification question on the topic. Because remember, there would be a difference between, let's say you get someone at BMW and they've got, you know, cars on the floor, right? So they've got cars on the floor. What would differentiate these cars from being classified as PPE, and what would differentiate these cars from being classified as inventories? Because that in itself is important. So you guys can get a theory question on this. That is one thing. Another thing is that even if you're doing calculations, you would need to obviously know the correct treatment of this, because you're going to classify it as PPE or investment property. That's going to be a whole different thing when it comes to your accounting treatments, your journal entries, etc. It doesn't sound like something that a lot of students get wrong, but you'd be surprised in an exam. And I promise you now that these nitty-gritty things are there. So keep an eye out for this during Monday's paper as well. Okay, make sure when you're doing your reading time, a lot of you have asked, okay, what do I do during my reading time? And I want to actually know what some of you do, right? So please type it in the chats, and I'll go to that now, and I'll answer some of the questions there. Please make sure that you guys focus on identifying the assets that are there in the question paper, okay? And then you can draw a column or something. Now, obviously, I know a lot of you guys are going to say that, well, you would have been doing this on the question paper. You don't have a question paper. So what do you write it on? So I would say that, if you can take your books as a hard copy, okay, even if you take a pencil and you have a blank page in one of your books, you'll have to use that, okay? You'll have to just improvise and do that. That's why I'm saying that this whole approach is a very yeah, like I said, I've got my own viewpoints on all of this, but you need to map out your answer, okay? Otherwise, your reading time is going to go for a waste. Okay, so I'm going to move on. I'm not going to sit too much on it. I'll answer questions after I've run through this slide deck, right? So the importance of inventories, this is just by the way information. This is just giving you some background. You guys will get the slides on this, but again, it's just information that is just building up for you guys, just to get you guys theoretical knowledge there. But obviously the main crux of the matter, because remember with the integration, we can integrate this, or rather your lecturers at UNISA can integrate this with management accounting, because at the end of the, and that's what I'm trying to do, I'm trying to knock other modules while I address this. So wherever there is an integration link, that's what my lecturing style is, because obviously at CCA level, everything is integrated. So you guys probably didn't think that MANAC would be coming up right now, but well, there you go, right? And this leads to issues in terms of profitability, because remember, I'm not going to go into detail because I know you're writing MANAC at the end, but it's important to bear this in mind, because at the end of the day, if a company doesn't have inventories, they have nothing to sell, they can't generate any revenue. Okay, remember, your revenue comes from what you sell in the ordinary course of business, and what you sell in the ordinary course of business is your inventory. So inventory and revenue are very closely linked together. No inventories leads to no revenue, and profitability, etc., etc. All of that will take a knock-on effect as a result of that. So bear this in mind, and there's nothing at all that prohibits or stops you guys from being asked something relating to inventories that is covered in management accounting in this paper. You won't have to calculate those hectic things like, EOQ and that. No, I don't think that go to that extent. But remember, integration is a very emphasized point when it comes to CTA. Okay, don't look at any module on its own. Don't look at accounting as just an accounting paper, because, at this level, that's not what Psycho wants. Okay. So we're going to move on from there to the recognition criteria. The first thing that you need to know, and this is going to be covered in PPE as well, 2 recognition criteria must be met. First things first, the company must own the inventories and have control over them, and there must be a reasonable expectation that the future economic benefits associated with the inventories will flow to the entity. A third one is that they must have a cost or value that can be measured reliably. Okay, so that's important, right? Cost or value. Okay, so I'll get into why the standard covers both, and you'll see it's the same thing for PPE. So in covering this, we're going to cover PPE as well, because the recognition criteria are essentially the same. Okay, and the same thing goes for intangible assets, same thing goes for investment properties. Now, obviously, in terms of your company owning the inventories, having control over them, that means the company has the rights to these assets. Okay, reasonable expectation that the economic benefits associated with them will flow to the entities. So in terms of this, remember, whenever you've recognized an asset on your balance sheet, right? Essentially what you are saying is that that value that you've recognized that asset at represents future economic benefits that you'll get, either in the form of cost savings, so a reduction of outflow, or inflow of money or other assets. Okay, So if you buy something cash, you'll sort of see that it nets off. Let's say you buy a car for a delivery vehicle for 500,000 rand, right? What you're going to do is you're going to typically debit the assets with 500,000, your PPE. You're going to credit bank with 500,000, and then it nets off. So do you see that it's almost like a transfer from your assets from one form to another, right? That's essentially, when you think about it in the broad spectrum, what you are telling the users of the financial statements that, hey, I've got this 500,000 cash, but you know what? I'm going to actually put it in an asset, and this asset is going to generate the equivalent of that in economic benefits in some way or the other, okay? So in terms of your recognition, obviously you need to firstly, when you're answering a theory question, also see whether the asset, whether it's PPE or investment property, whatever the asset is, does it first meet the recognition criteria? Don't jump into the whole costing thing as yet, because what's the point of calculating the cost of it if you can't even recognize it at that point? Okay. So that's something that you should be clear on, right? In terms of measurement, I've structured it in this way. You guys are, free to look at whichever way would be more comfortable for you, right? But obviously, that the initial measurement is at cost. Same thing with PPE, it's at cost, right? And the cost will be all expenditures that are necessary to bring the inventory to their location and condition. So the costs that I incurred in that, you guys know, you guys are very familiar with, you are comfortable with that. I don't think we need to go into detail with that. Just remember that conversion costs, these will typically only be in a manufacturing organization, okay? So during your reading time, if you see that you have a manufacturing organization, chances are that you would find conversion costs that are given, and these would factor somewhere in. That's why with, I think with one of my previous lectures that I did, I always pointed out that something in the manufacturing industry, even when you're looking at it in terms of auditing, is inherently more complex because there's a lot more working parts inside a manufacturing entity than a, retail industry, for example. So in your reading time, this is something that you want to also take note of. Even when you're doing auditing, is this a manufacturing entity or is it a retail entity? Because that in itself is something you'd consider. From an auditing perspective, what would you do? You'd say, well, this is a manufacturing industry, it's highly specialized, or it's a bit more complex. So that would increase your risk of material misstatement. Okay, that kind of thing. That's how you need to be thinking. Okay. Once you've got your cost, okay, you need to decide on a cost formula. Now, IS2 specifies the following three, that either FIFO, weighted average, or specific identification method. These are the three that are prescribed. You won't need to go and start doing hectic theory on this in an exam, right? What they can ask in terms of this, right? Because remember, certain things are for certain cost formulas are more suited to certain items as well, right? So by default, you will look at your specific identification first. Okay, so this is what happens, right? If you have inventories that are not homogeneous or, interchangeable, and they're very high value items. So we're looking at things like jewelry. We're looking at things like antique furniture. We're looking at things like cars. Okay, they homogeneous, like they're not homogeneous, right? They are different to each other. Okay, so if you go, for example, to a vehicle manufacturer and they're selling cars, and let's say we go to the used car section, right? Obviously, one car will differ from the next, will differ from the next, will differ from the next. It's not like if you go into Checkers and you buy a bag of Doritos, and if you take the one, it's pretty much the same as the only thing that'll change is, okay, find the flavor, but it's not changing the value. Whereas if you go to a car dealer and you go there and let's say you take a BMW and you just said, like, well, I don't like this. You can't go and exchange it and say, okay, well, I don't want this BMW. I'm going to go and take, a Toyota instead. And if they're just going to exchange it, then there'll be no difference in value or anything. The cars are completely different. The values are completely different. they're not even manufactured in the same way. So those kinds of things would stand out. So if you have inventories which are like that, and the nature is like that, then the standard requires you to apply your specific identification method. If not, then you have a choice of FIFO or weighted average. Okay, so you can't just go and take a thing. So you'll never find things like an antique store or even some of the furniture stores, the more expensive ones now, right? Or even the jewelry stores. If you pick up a set of financial statements, those of you who are in auditing might notice this. They will not be using FIFO and weighted average. Okay, and there's a reason why I'm telling you guys this is because at the end of the day, these are questions which you can get. I've seen these things get tested at CTA level where you have to sort of motivate which cost formula to the financial director would be suitable and why. And you need to know these kinds of theory things as well, just as a foundational thing. Okay, it often gets overlooked in CTA level, I know that, but I do emphasize a lot on these things because at the end of the day, you don't want to be losing these easy marks. It's like a real waste when it comes down to it. Okay. Questions I'll answer just once I've run through the slides, right? So when you come to your costing, your components of cost, these are pretty much straightforward. When you are calculating the cost of your inventories, what I highly suggest is when you're laying out your answers, okay, don't just write them down. Don't just put a heading that says cost of inventories and then just dump a whole bunch of costs there, right? There's a very strong reason I'm telling you. I would recommend that you actually will use these as sort of headings because it shows the marker. Number one, I identify as per IS2 what is required to be inside these things, right? Or what is required to be inside the cost of my inventories. And it lays out your answer in a much better and more structured way so that you can actually see where your costs are, what goes where, and how to allocate them. So like I said, if you have a retail industry, you'll just have your purchase price and you'll have your directly attributable costs. Okay. If you have a manufacturing industry, then you'll have all three components versus just the two. Okay. Now, with your purchase price, you've got your regular invoice price. Okay. Remember, if your entity is registered for VAT and you can claim the VAT, then you take the VAT out. You'll add any import duties, transport duties, handling costs, those things, right? Any taxes that can be refunded or recovered, you don't add them because essentially you're not incurring them. You're paying them, but then you're going to claim them back. If you include it in the cost of your inventories, you're going to be overstating the cost of your inventories. Okay, and that's then going against what IAS 1 and even the conceptual framework rather have in terms of prudence. Okay, that is a concept when it comes to the characteristics of your financial statements. Okay, I know I'm going a bit in depth on that. You don't have to stretch it to that extent, but it's just for you guys to keep in mind how all the standards link and why certain things are structured. You'll notice I'm very big on explaining the understanding and the why behind things, because once you understand why it's a certain way, you don't need to memorize these things. You don't need to swat it off. You don't need to go and start making laundry lists of things to remember. It'll click automatically, and that's the point you need to get at, because when you pass your CTA, you're going to do that when you're at a point where you don't need to be sitting and swatting this off. That's the irony. So while there's a lot of volume to get through, yes, the ironic thing is that you need to actually be at a point where you don't need to be sitting and swatting off. You need to be actually understanding this. So I've included an example here and I said, okay, for a bakery, the cost of inventories. Okay, now a bakery would be an example of a manufacturing industry, right? Because they're going to be manufacturing the goods that they sell, right? No bakery is going to be buying a cake from one and then selling, and then reselling it. Unless obviously sometimes with bread that happens, but not generally, right? And this is straightforward, easy to follow. I don't think that we need to spend a lot of time on it. What I am going to spend some time on is on net realizable value. Okay. And this is something that you guys must keep an eye out for in your question paper whenever they give you information on inventories. Because remember one thing, right? Whenever you guys get questions, you guys are going to get questions that are relating to your info to the end of the reporting period, right? And this is where net realizable value comes in very, very, very relevant in a very relevant way, rather, right? So you guys need to make sure that you've kept an eye out for information relating to this. Okay, the theory is pretty straightforward, right? This is how you would calculate it. It's going to be your estimated selling price less these costs. Okay, so the calculation behind it isn't what I'm too worried about. Okay, because I think that you guys are capable of doing that, right? So it's more the identification that we found becomes a problem, because they put it in a very indirect way. They'll never just come to you and tell you the net realizable value of the asset is this, or that. It's always where you'll get details regarding the selling price of your inventory, and then there'll just be other costs. Now, remember, there's a difference between net realizable value and when you're doing impairments. With impairments, you don't just impair. Remember, there must be an indicator that the asset's impaired, and then only do you test whether it's actually impaired or not. You guys remember that requirement, right? But with net realizable value, there isn't actually such a requirement. And you'll see, and that's why I'm like, really so many marks get lost on this in so many tests, it's like unreal. That's why I'm emphasizing it. Yeah, it might seem like I'm, doing basic work on this one, but trust me, right? Don't be surprised if you even see this on Monday, where you'll get the selling price for your goods. Great. Okay, happy. Right now you're thinking, okay, that's talking to revenue. So I know I'm calculating my revenue. Okay, fine. But there will be other costs that are there as well. Now you'll be reading your other costs that are given. You'll be thinking, okay, well, this is to calculate the cost of my inventories. And then they've given me other costs that don't form part of the cost of my inventories, like my cost of disposal and transport. So they're just testing me to make sure that I know I must exclude it. Okay, which is great. They are doing that. But indirectly, they also want you to calculate your net realizable value at the end of the year, because they've given you the information to do it. And at the end of the year, in terms of IS2, you are supposed to do that anyway. At the end of every reporting period, you don't need to be told to do it. Even in a question paper, they don't need to ask you for it. You need to know that automatically when you get information on this, or when you have inventories, you are valuing them at the lower of the two. And I'll be honest with you guys, I think that in 90% of cases where this information has been given, students have not actually done that. So where journal entries had to be processed, where, all those marks ended up being lost, where it was just calculations, let's say, those would also get lost, because naturalizable value would be a calculation that would get lost, but they wouldn't. But generally, you won't just get a calculation asking you for that. Where students had to prepare their statement of profit, loss, and other comprehensive income, the cost of sales figure was way out. So many marks would get lost there, because remember, when you have a write down, let's say we've written down our inventories by R1 million, we're going to credit our inventories and we're going to debit our cost of sales. So that never made it through. You see, even sometimes in some cases, the reversal. But the reversal doesn't get tested so frequently, because with the reversal, they have to tell you last year there was a write down. So then automatically, whereas where there's a write down this year, they don't have to tell you there was a write down. You must know that you must go and check that there was a write down. Okay, and this is how you're going to it's something which I want you guys to keep an eye out on Monday. I'm not saying it will happen, but it's something that you guys need to make sure. And when I'm saying you guys on Monday, because obviously all of you are not writing on Monday. I have some students that are not at UNISA, but for you guys need to just make sure that you focus on, identifying, because these are these nitty-gritty marks, and at the end they push you through. This can be easily something between 3 to 5 marks. Why do you want to lose it? Okay. And it's a fairly simple calculation. I'm not going to go into detail about that, right? So the measurement after recognition, that is just going to be at the law of cost to naturalizable value. You guys understand that, okay? I've given you guys a slide or notes on that, so we're not going to go through that in detail because those have the journals as well. So I don't think I did share that in the group, and that was actually available for everyone. So I don't think we need to do that in a lot of detail. Okay. A question on VAT. Okay, so when it comes to VAT, remember any tax that you can reclaim or you can recover from the entity, or rather from your taxation authority, you don't include that in your cost of your assets, right? So the scenarios with VAT you need to look at very, very carefully as well. Number one, the entity might just not be registered for VAT. Okay, very easy. If you're not registered for VAT, you can't claim VAT. That makes sense. I think we're all fine with that, right? Number two, the entity is registered for VAT, but they're only making exempt supplies. Okay, so if that's the case, they are VAT registered. There's nothing wrong with it, but they're making exempt supplies, right? Not zero-rated supplies, exempt supplies. You can't claim the VAT on it. Okay, so that's another thing to keep an eye out on. That's why I say that all the modules are more linked than you could believe. But in your case, obviously, they're going to give you an entity that, you know, it would be registered, and you would be able to claim the VAT. The only time I can envision VAT coming in, VAT could come in as a potential theory question in here, right? And it would be in a case of where the entity is now costing the inventories, and the financial director disagrees on what the management accountant has done, something like that, right? Now, I want to, just before I continue, I want to point out one thing. If you guys had to read something like this in the question paper on Monday, it would sound horrible because now all of a sudden they're talking about the management accounting, and now suddenly tax is there, and suddenly all of that. And, then you're going to come out of the paper, and then complaining on Facebook that, God, that paper showed you flames, which in some cases, there's always that one question that is going to do that. But if you break it down, right, using the question I gave you, it's integrating so many things, right? The financial director is unhappy with the performance of the company, feels that our cost of sales might be too high or too low. There might be an issue there, doesn't agree with the VAT treatment, has asked you to assist, right? You come in, you say, okay, fine, in terms of IAS2, these are the costs that need to be there, on our inventories. Okay, now the issue of VAT. Right, we can claim the VAT if we are paying it, and because in terms of IAS2, any sales taxes that we can claim or that can be recovered will not form part of the cost of our inventories or any assets for that matter, right? Now, what happens? We'll say, okay, look, we are registered for VAT. We're not making exempt supplies, and yeah, because I closed the window. That's why. Do you guys want to see the slides again? I can just open it if you need to. Because I just wanted to go through the chats just to see the questions. But anyway, getting back to the discussion that I had, let's say now you have to give him advice. So you're going to say that, okay, look, our entity is registered for VAT. We can claim the VAT on this because we're making taxable supplies. In terms of IAS2, any sales taxes or any taxes that are recoverable will be, excluded from the cost of our inventories. And as a result of that, you can, we will have to exclude it. That's how you're going to build up your answer. Okay. So do you see it's linking so many modules, which is what you should expect at this point, right? But the answer is relatively straightforward. You just need to break it down into those elements. And it's these nitty-gritty things that you guys are going to get tested on. Your calculations and all of that, you guys know. I know you guys know it, right? I can do that from now until Monday morning. It's not going to help you pass because you guys do know it, okay? please repeat recognition criteria and how to structure it in the exam. Okay, so what I will do, I'll type notes in the chat here so that you guys can actually follow it through. You guys will see it in the recording as well. I did do this during the auditing class. So for those of you who were there in last week's one, that worked pretty well. So I'm going to follow the same approach now so that you guys can follow in the chat, and you'll see exactly how I suggest you structure your answers. Okay, so cool. Okay, I'll type out. Right, the first thing you want to put down, right, is you would need to say that there are 2 recognition criteria that need to be met. Okay. Okay, so that's the first statement that you make, right? Sometimes, because in some memorandums I've actually seen that this gets awarded a mark, sometimes half a mark. So I'm not saying that this is going to be the case, but I would suggest that you guys type it down anyway, because it gives structure to your answer. It shows the marker that, okay, there are 2 recognition criteria. Number 1, I've identified that there's 2 as per IS2. Number 2, I'm going to be giving you 2 recognition criteria in my answer. Okay, because if you have to just say IS2 provides a recognition criteria and then you only put 2, if the marker wants to be really strict, it'll be like, well, I don't know, this guy knows everything. I mean, you know, maybe you was just looking for other things, maybe this is only you, yada, yada, yada. And you don't do, the point is you don't want to be at the mercy of the marker. Okay, right? So the first one I would say is, okay, the first thing is the entity has control over the assets. Okay, it's not specifically in IAS2, but in practice, this is something that does get looked at, because the thing is, if you are selling something that, you know, almost like as an affiliate, you know, on behalf of someone else, you're not really keeping that consignment stock in your books. Because remember, even in auditing, I don't know if you guys have gone through your procedures. If you're doing your auditing procedures, one of the substantive procedures will be to see your consignment stock and make sure that they haven't been included as part of your stock. Do you guys remember that, or have you guys come across that? Or is that something new that you guys learned? Because it is, I'll be very happy. Then at least we be knocking auditing as well. But these are the things that you need to think of. Do you see how your modules link up? You see, there's nothing that's separate. You know, they all link up in this way, right? So that's something that happens in practice. Those of you who are in auditing or who are in public practice, rather, it will be a little bit easier for you guys. I know some students of mine are unfortunately not. And you know, when you're in a different industry, then relating to the two does become a bit of a bother. I know that. But at the end of the day, it's just one of those adjustments or improvisations that you need to make. Okay. Then the second thing is that the future economic benefits associated with the asset must flow to the entity. Right. Now, this is what you'll put as a heading, right? Now, some students have asked, okay, do I put it in a table format? Do I put it in a paragraph essay type format? That is up to you, whichever way works for you. I would suggest that you just see which way in the exam is going to be the quickest way to answer it, okay? Now, given the fact that you actually have, you guys can be answering on your laptops, right? So they're going to allow you guys to use Microsoft Word, etc., if I'm correct, because I'm assuming that's, well, you know, the bulk of your questions would be done on there. Although I would be doing a lot of stuff on Excel if they do allow it. For example, like your notes and stuff. And what I am going to do for you guys is that I'm going to prepare some stuff, just like layouts and stuff on Excel, so that you guys can actually see what it needs to look like. And then you guys can prepare it accordingly in the exam. Okay. So then you save your time of sitting there in front of a spreadsheet and then thinking, okay, how do I structure this note? How do I move this column that way? That you're not, half an hour can go in just doing that. Okay, even at work, it takes a lot of time, and you guys don't have that type of time in a question or in an exam anyway. Okay, moving on, right? The future economic benefits associated with what the asset must flow to the entity. So economic benefits can be remembered two ways. One, a reduction of outflows or an increase in inflows, right? We're happy with that, right? We know that. Now, important to point out is the fact that when you are dealing with an industry that has a large degree of obsolescence, it's important to bear in mind that your inventory might be written off. So let's say, for example, okay, let's take the first scenario. We have a normal industry where there isn't a lot of obsolescence, right? You buy something, we're going to sell it. Let's say it's, groceries. We know that, okay, people are going to buy groceries all the time. They won't get obsolete. The shelf life might be limited, but that'll be addressed as part of the write-down. But we're going to sell this, and when we sell this, we're going to sell it for cash. The money that will come in will be for our own accord. It's going to be received on behalf of the entity itself, right? So you need to break it down, right, in terms of future economic benefits being either an inflow or an outflow. So I would say 2.1, future economic benefits, and then you'll discuss that, where I said, okay, it's going to be the inflow or the outflow. And then in terms of, I'll answer your question now, Bonga. And then the second part is to the entity. Okay. So the first thing, because here's the thing, if we're selling all of this, but the economic benefits are not coming to us, then what's the point? It's not our economic, because anything on your balance sheet under your assets talks about economic benefits that you are going to receive. Okay, you as the entity, not another company or something else, because then that takes you into a whole principal agent relationship kind of thing that will be discussed in revenue tomorrow. So it is important to mention this. You must mention that as well. So break it down that way. And then the third one is cost or value that can be measured reliably. The cost part is easy, right? It has a cost that can be measured reliably. This is just in most cases when we buy something, there's the cost. We calculate the cost in terms of IS2, no complication there, right? But the standard also talks about a value. Now, why do you think the standard makes reference to the term value? Any one of you can guess, whatever. Why do you think the standard talks about value? I see a few people are typing, so I'll give you guys a chance to type the answer, and then I'll tell you guys.
Muslim?
Yep.
Isn't it because the stock can be recorded at a lower of cost or net realizable value? Therefore, it can be remeasured. So that's why I think they use the term value. I'm just thinking.
Yeah, but that's subsequent recognition. So why at initial recognition are we talking about value? You're on the right track. You are on the right track, but why is it that at initial recognition they take cost or value? Because you won't recognize it at the lower of cost or net realizable value at your initial recognition stage. Okay, it's the entity's profits. Nope, that's not it. I'll just take one more answer and then I'll give you guys the answer. Okay, not quite either. Okay, so this is a very important thing. Guys, can we record inventory at fair value? No.
No.
Can't. Okay. This is okay. Just waiting for, because I can see someone else is typing, so I'm just waiting for the answer, and I'll give you guys the answer just now, right? Okay, I see the typing stopped. Okay, so let me give you the answer. Actually, there's nothing in the standard that prohibits you from recognizing your inventory at fair value. Because you can recognize PPE at fair value, can't you? You can recognize intangible assets at fair value. You can recognize your investment property at fair value. And I'm talking about initial recognition, not on the fair value model that happens afterwards. So when would this happen? If you think about an exchange transaction, you guys remember that I have an asset and I exchange it and I obtain another asset in exchange. Remember, it comes more in the case of PPE, not really so much in the case of inventories, but in the case of PPE, it does get covered, right? So you guys would remember that, right? What about if I get an item of inventory donated to me? Let's say I'm selling stuff and someone donates inventories to me. I didn't pay anything. There's no cost for those inventories. But if I'm going to be taking them onto my statement of financial position, surely there's got to be a value for that. Does that make sense? So yeah, MV, I'm assuming you're talking about market value. So yes, that's your fair value. So there are certain cases, and that's where the standard makes provision for it. So the standard doesn't explicitly say, remember, IAS2 is a very old standard, okay? Your fair value standard came out like, quite later on, right? A couple of years down the line. And there's a lot more standards that are still coming. All of these standards that are here are going to undergo so many revisions. Like, I mean, all of you know that IFRS 17 is out, right? IFRS 18 is coming out next year, or it's being drafted. That's going to replace or add to IAS 1, right? So yeah, please get your CDA unless you want to learn IFRS 18 also. So the thing is that there's constant changes with all of this, but the standard does allow you to actually recognize something. So if we had to do, let's say we got something for no consideration, we got inventories for no consideration, right? And this can be applied to all your other assets. That's why I'm spending a bit of time on inventory, but the principle is going to extend across all of these other assets as well. What would the journal entry be? Let's say I got stock for 10,000 Rand for free. What's my journal entry? No one wants to guess. Okay, well, debit inventories, let's say that. I think we're all happy with that. What's my credits? Bank, but I didn't pay. This was donated. No, can't be cash. They donated inventories to me. So why am I crediting bank? I didn't pay any cash. And this can be, again, applied for PPE. It can be applied for intangible assets, all of that. What would I credit? Cost of sales. Close. Close. I see 2 people are typing, so I'll wait for their answer and then I'll move on. I don't want to sit too long on inventories. I want to move to PPE and, you know, the more nitty-gritty stuff that will be tested. Cost of free assets. How does it have a cost if it's free? I can see we're going to have fun with this topic. And remember, this can come for PPE as well, right? If you guys studied government grants, it should be a bit easy for you guys to know this one. So IAS 20 supports the principle, but okay, market value. Okay, now let me give you guys an answer. You'd credit other income, okay, unless there were conditions attached to the receipt of the inventories, in which case you'd credit deferred income. Right. That's why I said IAS 20 on your government grants would be linked to it. So doesn't government grants tell you that you get your grants, receive your assets, and then you'll have conditions? And then I'm going to tell you now, right? What would happen? You receive an assets, and then what is the definition of income? Look at the definition of income. Increase in assets or decrease in liabilities that result in increases in equity other than increases resulting from equity participants. That's a definition of income. Is this not an increase in assets? Does it not meet the definition of income? Yeah, well, then there you go. That's why it's other income. But you'd only take it to other income, and then underneath your other income, if you want to give it more detail, by all means, then you can say, you know, asset received for no consideration, whatever you want to call it, right? Or asset received via donation, you know, that kind of thing. But if you got cash for nothing, you would have done the same thing, right? So with the inventories, it comes to the same thing, right? What would we have said if we had received cash for nothing? We'd have debited cash and credited donations received, right? So this is the same principle. It's also an asset. It's just a non-cash asset. So if you got PPE for nothing, same thing. You would have debited PPE, credited donations received, or it would have gone under your other income. You guys learned something new with this one. It sounds like, or it seems like the first time you've encountered this. But that is what you would record it under. Okay, both for assets and for your not your liabilities, which are both your inventories, your PPE, even intangibles will go down the same path. Investment properties. If you received a financial instrument for no consideration, even that. By the way, why is there no VAT referred to on financial instruments? Because, well, let me just tell you, right, financial instruments, they exempt, you know, financial services are an exempt supply in terms of Section 12, I think. So the thing is that there will never be VAT on financial instruments. Okay. That's why you'll see that there's no thing like VAT on your loan received. Okay. So are you guys fine with with the inventories? That you guys learned something new on your inventory side? Because then I can move on to our PPE section. You guys will notice that my style of lecturing is quite different on what you'd normally get, because look, if you're going to go through the whole, you know, here's the standard, here's the same stuff. I mean, you guys probably have 1,000 slides on you know, in terms of what you know, going through the same content, but it's these out of the box question. Your question. What was your question? Did I miss it? It's in IS2. I'm not sure of the paragraph number exactly, but it's in IAS2. Okay. All right, so I'm going to move on to our IAS 16 from this point. Do you guys want to take a break, or are you guys okay to continue? If you want to take a break, we can take a 5 minutes 5-minute break, just no more than that.
Hi, Malcolm.
Hi.
I just joined in now. I haven't received the slides.
Yeah, they dragging a bit on sending. So what I'm going to do is that I have sent them by email to everyone, so they might just be coming through during the course of the lecture, I'm guessing. So, but I'll follow up. But I have sent them already, and I put them on the chat as well. But I don't know why it's not thingy. But they are quite big, so maybe they're taking time. Others, what I'll do is I'll also create a Google Drive link for you guys, and you guys can just download it. I'll do that after the lecture, then you'll have access to that. And then I'll upload other material there as well, together with the recording. Then you can access everything there one time.
Okay.
Okay. Okay, so I can continue. So everyone, you guys don't need a break. You're all fine. Okay. So now IAS 16, okay, the structure I've used is pretty much the same for our inventories, right? I haven't deviated too much from there, right? What I want you guys to pay particular attention on when it comes to IAS 16, okay, is the initial measurement part of it, because the cost on your IAS 16 is an important factor, right? Now, most of you guys don't have too much of a problem when it comes to your general costs that have to be included, okay? So by this, what I mean is that you guys easily can calculate your purchase price. You guys don't have any other like issue on that, right? Or your import duties and all of those kinds of things and whatnot. You guys are fine with that, right? What you guys generally seem to be making mistakes on is on the dismantling provisions. You guys sometimes seem to forget about that, or you guys seem to forget about your deferred income, deferred consideration. So deferred consideration is not so much of it. I think that gets tested with your PPE, with your inventories rather. But with your PPE, this is something that does come in, right? So these are the two things that I want you guys to take special note of, right? So when it comes to your deferred consideration, right, you guys know your deferred consideration is just basically, right, in a nutshell, going to refer to a situation where we're not paying the supplier for the machine right now. We're going to pay the supplier for the machine, let's say in 9 months' time, right? So what then do we recognize the assets at? Okay, and they will tell you that the normal credit terms are 3 months. Okay, you come across that scenario like quite often. So let me just type a few notes on this. Okay, right, on your deferred consideration, or deferred settlement rather, not consideration. I'm thinking of revenue. Okay. So just let me know if all of this is coming up on your guys' screen. Number one, right? Take note of the normal credit term period of the entity. Okay. So this is your first step, right? You take note of what your normal period of credit is, right? They will tell you this. Okay. This will be given, and you guys just need to go step by step through this process, right? So they will tell you the normal credit term is 3 years, not 3 years, 3 months, but we're only going to pay after 9 months. So let's say we have a situation like that, right? We're paying them only after 9 months, but normal credit, or our normal credit term is 3 months. what is considered to be abnormal for the purposes of our calculation? 6 months or 9 months? Six. Okay. And do all of you agree with 6? Okay, so actually for the purposes of the calculation, 9 months would be the correct term to use. So n in the calculation okay, so it's the full term. Okay, so you don't say, okay, 9 months you're going to pay them after that, and then you only just take into account the 6 months and say, no, that is abnormal. You take the full 9 months. That is a very common error we've found with a lot of students that a lot of students have made. Okay, you need to be very, very hands-on in terms of this. Okay, make sure that you take note of this, because a lot of students get this part wrong, and then your present value also goes off, right? So make sure that you've recognized that. Okay, you guys are happy with this. Okay, so let's say we have a situation, we're going to pay the supplier, we're going to buy a machine from the supplier, we're going to pay the supplier after 9 months. In the question, they tell you that the normal credit period of the client or of the entity is 3 months, right? So what is considered to be the abnormal credit term, right? 6 months or 9 months? So Shaheen answered and said 6 months, but it's not 6 months, it's the full 9 months. Okay, you take the full credit term period into account there. You don't say that, okay, 3 months is normal, so therefore 6 months is abnormal. Doesn't work that way. You take the full 9 months. You guys are okay with that? Okay. Right, so then I'll move on from there. The second thing that I want you guys to take notice of is when it comes to your dismantling and to your removal costs, right? These will, in most cases, be given in the question, right? They'll tell you the future value, and they're going to tell you the discount rates that you must use. Now, your discount rates, your discount rate must be after tax. Okay, that's another thing that is important for you guys to take note of. You have to have an after-tax discount rate, not a pre-tax discount rate. Okay, would N be in months or years? No. It depends on what the question gives you, right? So if you're going to convert everything in N into months, then you need to convert your interest rate into months also. So what I'll say is, if they give you like 2 years, 3 years, and it's a full number, keep it in years. If they give you something like 10 months, then make it in months. Because if you're going to convert it into an annual period, then it becomes a bit messy. Because you need to remember to make your interest rates in months also. Remember your time period and your interest because interest is a function of time, need to be measured on the same basis. Okay. So if you divide, if your interest rate is over time, then it's the same thing. But yeah, so it's up to you guys. I mean, what you guys can do, you can do a standard thing where you say, look, you're always going to just work on months so that you just convert into a monthly interest rate and you will get to the same amount. So if you want to do that, that's fine. I don't think it's necessary. Okay. But yeah, you can follow that approach. I hope that makes sense and answers your question. And like I said, your discount rate, your interest rate must be after tax. I mean, sorry, not after tax. It must be pre-tax. Sorry, missing after tax. Okay, right? Because you'll deduct tax at the end afterwards, right? So sorry, so not after tax. Sorry, it must be pre-tax. Okay. So just keep an eye out for that, right? So this is the correct one. Okay, this one here, not after tax, right? Pre-tax. So you'll see that they'll give you an after-tax discount rate. In most cases, you just need to know to convert this into a pre-tax discount rate. Okay. And if the interest rate, let's say, I mean, if the tax rate is, let's say, 28%, let's just stick with that. And the interest rate that they've given you is 7%, and they've told you that is after tax. You're just going to be saying 7% divided by 28%, or 7% rather over 0.72 rather. And you're going to get to your answer. Is that clear? Because that in itself is like a free mark for doing just that calculation. It's a very easy calculation to do the mark, to gain a mark for. And you guys want to make sure that you're not missing anything. Okay. So that is in terms of the cost, right? Now, if there's no other questions on cost, so I'm going to move on to the component method. Okay, let me repeat it, right? So in terms of your discount rate, I'm assuming you want me to repeat. Okay, if you're going to do your discount rate, right? Your discount rate must be before tax, right? Pre-tax. So if they give you an after-tax discount rate, then you must take that tax rate and convert it into a pre-tax discount rate. Okay. So then what you will do is, let's say your tax rate is 28%. Okay. Then at the end of the day, what you will do is you will take that. Let's say it's at your 7% after tax. You'll say 7% is my after tax rate. Divide that by 0.72. If you wanted to get to an after tax rate, you would have multiplied by 0.72. You want to get to a pre-tax rate, now we'll divide by 0.72, and then you'll get to a pre-tax rate. Remember, your pre-tax rates will always be more than your after-tax rates. So if you do your calculation and you've gotten a lower amount, you know you've done something wrong. When do you use an after-tax rate? After-tax is more in terms of your management accounting when you're looking at WACC and financing. It's not really for financial accounting. So you think you're confusing MANAC and accounting right now. Okay, because with accounting, generally, you use pre-tax rates for the purposes also being, remember, financial statements need to be comparative and you know, from entity to entity on a global level. So tax rates differ from one country to the next. So you can't use an after-tax rate in your financial statements and reflecting that an after-tax rate, because then it's going to either favor or disfavor some people. If you discount things using an after-tax rate, let's say in an entity or in an environment where the interest rates are very high, then the assets will inherently be lower, because the higher the interest rate, the lower your present value will be. So, you know, they just get disadvantaged in that way. So to ensure comparability, because tax is like a very variable rate from entity or from country to country, you're always gonna work on the pre-tax for financial reporting. Okay, just use that as a rule, and then unless the standard or there's a requirement that deems otherwise, but you would stick to your pre-tax. For your management accounting, you will deal with after tax because that comes into decision making and all that. So for your capital budgeting, that's after tax. For your valuation, that will be after tax. For your WACC, after tax. Okay, you guys remember that, or you guys still need to start studying for management accounting? Okay, so I'm going to move on from here to the components method of depreciation. Okay. Because that's another aspect that you guys can make reference to. Now, I didn't put this in the slides because the slides are covering more theory, right? I wanted us to do the component method more as a, discussion and actually working with one another on this, because it's something that needs to be more interactive, okay? Because if you're not going to have an interactive session on your components, then it's going to just it makes things a lot harder. Let's put it that way. Okay. So how are you guys when it comes to the replacement of components? Do you guys understand it, or do you guys struggle with this? Give me some indication so that I know how much of time to spend on it. Okay, I don't need help. Also good. Okay, so then it's fine. I don't need to spend too much of time on it. Okay, the reason I'm asking is because it is something you guys should expect. Okay, Psycha test this like crazy for some reason. I've seen it so many times. A good paper to go through would be the Psycha 2012 QE. Go through that. There's a question on the replacement of a component. Very good question. Lay out your answer like that and you'll get a lot of marks. Okay. Can I give a short summary? Okay. Basically, when you're dealing with your componentization, okay, the question paper will always give you one asset. Okay, so in the question number one, you'll have one asset that has components, right? That's the first thing that you need to know, right? They're not going to give you every asset that has components. It's an overkill, right? Secondly, this assets will typically be, and go through your questions. If you guys not noticed this, that every asset that seems to be on the component method is usually on the cost model. Just pay attention to these things, right? You will start picking these things up as you get more adept, or which doesn't necessarily be the case, because if you consider a building, a building's got so many components that can be depreciated separately, yet they'll never tell you that in the question. They'll always give you like a helicopter or a car, or like, a furnace was always the favorite one, an aeroplane, and they'll always tell you it's on the cost model. Okay. Then the third thing is that either the component statement. Okay, now this is what you need to also look at, right? Either it was identified as a separate component or it wasn't. Okay, they will tell you this in the question paper as well. Now, sometimes I think, the general thing is where they always say that it wasn't recognized as an initial thing. So what I would suggest you guys do is lay out your answer because you guys are going to be on Excel and you guys are going to be able to do this. So I would say that you can lay out your answer. A good structure would be to have this as a PPE note, and then you would just say, okay, well, you know, I've got like the helicopter, right? And then let's say there's or let's use the example of an aeroplane with seats, right? So you'll have the total assets column. You'll have the one column for the, you know, main body. Let's say that's 7 million. Let's say the engine was 3 million, and the total is 10 million for the whole aircraft. Right? You'll do each component separately because effectively it's a separate asset. That's essentially what it's, you know, communicating. So for the replacement of a component, you treat as the disposal of an asset. Because you will dispose of this part of the replaced part at its carrying amount anyway, right? So this isn't something that's too hectic. You won't get a very, you know, gruesome question on it. But you guys are fine with it, right? And I think your tutorial letters should cover it. If you guys do need to go through this and you're not sure, I would say go through the example in descriptive accounting. Descriptive accounting does give a very good example. You won't get anything more complicated than that, or you know, this and major inspections. It's pretty much the same thing. Okay, you're not going to have a hardcore question on this one. Okay, so you don't need to go berserk on it. The main thing is that you just know that that component that you've now replaced, you just treat it like an asset disposal. Basically, it's the same principle if you think about it, right? You're going to depreciate it up to the date of disposal, and then you're going to dispose of it at its carrying amount. Then you'll recognize the new component, and then you'll depreciate that for the rest of the year. And then you look at the main component, you'll depreciate that, you know, from start to finish for the rest of for the whole year. You'll add the two carrying amounts. You'll get to the final carrying amount. It's pretty much like that. The only thing is, like I said, you know, in terms of you guys laying it out, I would say that because you guys are going to be doing it on the laptop, I would go the Excel route. I'd put it as an Excel thing. Do you guys want me to like sort of draw out? I won't do it now because we won't finish the lecture then. But then I'll do it separately and then just upload it for you guys. So it's sort of like a template maybe that you guys can use. Then you guys can sort of just see what it should sort of look like. I'll do the one in descriptive accounting like that, or you know, something like that that you guys can see. So you go into the exam, you should do your question in a similar way and lay it out. Then at least you have a template, because writing it out is going to be a huge mess if they give this to you. It's going to be a total disaster. You have to write out your answers. Okay. Why are some students telling me you have to answer on the laptop? Okay. Okay, then it's fine. Then you guys don't. Okay, then you could just stick to whatever is working with you. Okay, or for you. Okay, so I can move on from this topic, right? Now, on the issue of depreciation, you guys should be fine. I don't think that you guys need to, you know, I think at this point you guys can all, you know, follow. The one tip I'll give you is don't forget about residual value. Okay. Because in your depreciation questions, I don't know why, but you guys don't take this into account. Okay. It's almost, it's sometimes 1 mark that just goes on this and you guys are losing it. So if there's 2 or 3, you know, I mean, it's easy marks, right? So always on Monday, whenever you have your assets, just make sure that you take your residual value into account. Obviously, under exam pressure, things can happen where you would forget this, but please remember to take your residual value into account always, right? These things are getting overlooked by so many, and then it's just like a nightmare. How do we deal with a change in residual value? A change in residual value is a change in estimate. Okay, so that's an IAS 8 issue. Okay, you would treat it in the same way as the change in your depreciation rates, your useful life. So you remember how you do your change in useful life, your old depreciation minus your new depreciation, that whole thing. And then you'll say what the difference in your depreciation will be. You know, you draw up your old notes on what they call it, change in adjustments in terms of IAS 8. It's the exact same thing. Exactly the same thing. The only difference that instead of your useful life being changed, it's your residual value that you change, but everything is exactly the same. You're going to calculate what your depreciation using your new residual value is. You're going to calculate what your depreciation using your old residual value is, and then that's going to be your change in depreciation on an annual basis, and then you're going to draw it up. This is more of a disclosure issue than a calculation. And remember, change in residual value and useful is effective as the beginning. So what this means is that if the residual value changed, let's say from 5,000, it was last year, this year, the residual value at the end of the year, we assessed it, because remember, you will do a reassessment at the end of the year. At the end of the year, we reassess it as 7,000. Depreciation for the current year will be based on the 7,000 residual value being taken into account, not the 5,000. So let's say we have an asset, it's 100,000 cost. Now we need to calculate the depreciation on it. Last year it was 5,000 as a residual. It will be now 100,000 minus our 5,000 times our depreciation rate, which let's say was 20%. It will be 95,000 times 20%. It's just under 20,000, right? Now with your current year, let's say they said, no, we changed it to 7,000. Even though the change gets done at the end of the year, this sort of gets accounted for, you know, retrospectively from the beginning of the year, right? So there's no adjustment or anything that you need to make. Depreciation is calculated at the end of the year, but it's, you know, based on, you know, for the year, based on the year end amounts. So you will say that the cost, that 100,000 minus the 7,000, because now at the end of the current year, you've reassessed your residual value as being 7,000. Okay, you don't say, oh no, it was 5,000 last year, so the opening residual value is 5,000. No, there's no such thing. Your effective residual value is at the end of the year is what you will use. Same thing with your depreciation rate. Let's say we changed it to 15%. We would have said that times 15% at the beginning of the current year. Okay, not the whole what they call it, the old amounts. Okay. In simple terms, depreciation for the year is always based on the newest estimates. Okay, makes sense. Okay, any further questions on this? Okay, I'm going to take that as a no, and I'm going to move on. Now, when we're looking at our subsequent measurements, right? You have the cost and the revaluation model. The cost model, you guys all know that, everyone's happy with that. There's no issues on in terms of that, right? I think your guys' issues will be more on the revaluation model. Okay. So how comfortable are you guys with the revaluation model on your depreciation? Because the cost model, I mean, at this point, you guys should be knowing backwards, because that's like undergrad stuff. Okay, I don't want to waste time on that, but on the revaluation model, tell me what your questions are specifically, because I can go into a lot of detail on that. But the one thing that I want you guys to take note of always, okay, not comfortable at all, please go through it. Okay, that's what I figured, right? Is that the first thing first is that what the first step that you need to get to, right, when you are doing a revaluation, is you need to get to your net replacement cost for the assets. Okay. That should be your first calculation that you arrive at. Okay, your net replacement cost. Okay. Sometimes this will be given, and sometimes you will need to calculate it. It really just depends on what the question tells you. So net replacement cost is great, right? But the thing is when, okay? And that will be as at date on which the revaluation is accounted for. So it's not the date that the revaluation takes place. Okay, that's the other thing you need to be in mind, right? It is the date on which the revaluation is accounted for, right? Now, what do we mean by that? We can have the case of where the revaluation takes place at the beginning of the reporting period, right? Or it can take place at the end of the reporting period. Okay, you guys are familiar with that whole thing, okay?
No, sir.
You're not familiar with that.
Yes, I'm not.
Okay, so that's an important principle for you guys to note, right? The revaluation can take place either at the beginning of the year or it can take place at the end of the year. Okay, so that's just something, let me type that out now, right? Okay, so that's your first thing, right? Either at the beginning of the year or at the end of the year, right? One of the two times. Now, usually you're going to get the revaluation happening at the end of the year. Right? Guys don't need to stress too much about that, right? But it can happen at the beginning of the year as well. Okay, so you must just keep an eye out for things like this. Now, the second thing is that if it happened at the beginning of the year, it's not difficult because you would then just determine your net replacement cost at the beginning of the year, and you would use that as your basis and continue. Okay, so that's not a problem. If so now at the beginning of the year, right? So that's simple. So let's say we have an asset, a building, it was R1 million. We revalued it to 1.2 million rand at the beginning of the year. We'll calculate our depreciation based on that million, on that 1.2 million. It'll be the 1.2 million divided by the remaining useful life. That'll give us our carrying amount at the end of the year. Okay, it's dead easy. That's not really a problem. Okay, so that should be fairly straightforward for you guys to follow. All right, that's at the beginning of the year, right? Not normally a question that gets tested very frequently. Usually you get questions weights towards it's where the revaluation happens at the end of the year, right? But it can happen at the beginning of the year as well. And this is actually in your tutorial, so I remember it because when I was studying I saw it. So I know that it's it's there. So just keep an eye on it because you know what, that curveball can come from anywhere, you know, and something simple like this could have tripped you up on Monday. Okay, so if again it took place at the beginning of the year, all that's going to happen is that you're just going to do your evaluation at the beginning of the year. So those journal entries are fine. That's not the issue. You're going to debit your asset at the new value. You're going to credit it at the old carrying amount. And then you're going to just have the difference as your revaluation surplus or deficit, right? But you will calculate depreciation for the year based on the new carrying amount or based on this net replacement cost at the beginning of the year, and then you will get to your carrying amount at the end of the year as normal. Calculating your net replacement value, that is where the thing comes in, because remember, here I've told you very straightforward, they revalue the asset to 1.2 million, right? That's our net replacement cost we find. What they might do is they might not give you that. They might tell you that the gross replacement cost of the assets is 2 million rand. Now you can't use that 2 million rand, right? So you need to get to your net replacement cost, right? Your net replacement cost essentially is your gross replacement cost depreciated. So basically it's like saying that if we had to acquire this asset at 2 million rand, at, you know, as at the date of initial recognition, what would its carrying amount now have? And you evaluate to that. That is, so let's say we acquired this asset for 1.2 million rands, and you know, we've depreciated it up till this point, and the value is now 500,000. Now they tell you, you know, the gross replacement cost of this is 2 million rand. What you'll do is you'll say, okay, 2 million rand. So if we had acquired it at 2 million instead of 1.2 million, what would the carrying amount have been? And then you'll do the calculation. Let's say instead of 700,000, you get to 1 million rand. So that's your net replacement. And then that's your net replacement cost. And you'd say, okay, that 300,000 extra, that's your increase in your revaluation, or that's your revaluation surplus. Okay, let me just type it out, right? Your net replace, it's a bit concerning that you guys don't know this one though. Okay, so your net replacement cost is your gross replacement cost depreciated from the date of your initial recognition of the asset, as if you had acquired it at that cost, right? So either they'll give you your net replacement cost, so you're very lucky if they do, all right? Or it's going to be that they'll give you your gross replacement cost, and then you must depreciate it to get to your net replacement cost. Okay, does that make sense? Are you guys comfortable with that? Yeah, I'm going to assume that you guys are, right? So whenever you get your gross replacement cost given to you in a question, right? To get your net replacement cost as at the date of on which the revaluation is accounted for, right? You'll just depreciate it as if you acquired the assets. Let's say you acquired the asset 10 years ago. She'll say, okay, 10 years ago, if I had acquired it at the gross replacement cost instead of its historical cost, what would the carrying amount have been? And that will be your net replacement cost. Okay, pretty much that's all, right? So you're just depreciating it, you know, using the gross replacement cost. Now, let's say you get a revaluation that is done at the end of the year, right? If a revaluation is done at the end of the year, remember I said that if we do a revaluation at the beginning of the year, that net replacement cost, we'll just say that net replacement cost divided by the remaining useful life at the beginning of the year, that'll give us our depreciation for the year. We get to our carrying amount, we're done. It's very simple, right? What happens if we revalue the asset at the end of the year, right? And this is the one which you're more likely to get in your exam, right? Where you're revaluing the asset at the end of the year, right? What they will tell you now, either you will, you know, go back and perform the revaluation retrospectively as if it was done at the beginning of the year, or you will keep it as at the end of the year, right? Someone's mic did that anyway. Now, if it's at the end of the year, there will be something in your additional information that will say something like depreciation for the current year is based on the most recent revalued amounts or the most recent carrying amounts or something like that, right? Look out for something like that. How many of you have read something like that in the question and wondered why they're telling you that? Because you must have come across that every single question paper that wants you to do the revaluation retrospectively will cover that. So do you guys remember going through your question, doing any questions, even now in your tutorial letters, and you would have read that it says, depreciation for the year is based on the most recent revalued amounts or the most recent figures or the most recent estimate, something like that. Do you guys remember? You would have noticed the question saying something like that, right? If the question does tell you something like that, what they're basically telling you is that, yes, we revalue the asset as at the beginning of the year. Our net replacement cost is, let's say, 1.5 million. But we want to base our depreciation on the amount that would have been, the carrying amount as at the beginning of the year, right? So essentially, what you will need to do is you would need to go back and you need to add depreciation back to that revalued amount, right? So what you'll do is to get to your revalued amount as at the end of the year, because now it's as if they're accounting for it at the end of the year. It took place at the beginning of, it took place at the end of the year, but now they're accounting for it at the beginning of the year, sorry, right? Now, what you'll do is you'll take your net replacement cost as at the end of the year. Let's say it's 1.5 million. You divide that by your remaining useful life as at the end of the year. And multiply that at the end of the year. They will give you this, right? They then say the remaining useful life as at the end of the year is 5 years, right? So it's 1 million over 5. What is the remaining useful life at the beginning of the year? It'll be 6 years, obviously. So it's 1.5 million divided by 500,000, 300,000. That 300,000 times 6 is 1.8 million. That is our 1.8 million at the beginning of the year. So our net replacement cost at the beginning of the year is 1.8 million. Happy with that? What is our remaining useful life at the beginning of the year? The 6 years, which will give us 300,000 depreciation. So then we work back to the 1.5. Does that make sense? Are you guys following me? Oh.
No, Simi, I'm lost.
Okay, you are lost. Okay, so one person's following. Let me try and explain it in a simpler way. Okay, let's say they give us our net replacement cost is at the end of the year now, right? So net replacements at the end of the year. Right. Now they tell us that depreciation for the year is based on the most recent revalued amount. Okay. Now the net replacement cost at the end of the year, that's already done. That is the value of our asset in our books. We don't need to depreciate it or impair nothing. Okay. It's already the fair value of the asset. Right. So that goes straight into our books. We don't do any adjustments to this. Now, what was our depreciation on the asset? We don't know at this point. Right. So they will tell us that, depreciation for the current year was based on the most recent, estimates and things like this. So we, the most recent estimates or most recent revalued amount is at the end of the year. They will give you something like that in the question. So we need the net replacement cost as at the beginning of the year. Okay. So let's say that our remaining useful life is at the end of the year. was 5 years, right? To get to the net replacement cost at the beginning of the year, you're going to have to just say net replacement cost at the end of the year divided by our remaining useful life at the end of the year, multiply by the remaining useful life at the beginning of the year. Okay, so let's say I'll do an example on this and then send it to you guys as well. I think you guys will see it a lot clearer there, right? If the remaining useful life at the end of the year is 5 years, then obviously the remaining useful life at the beginning of the year would be 6 years, right? Because it's 1 year more. So you're just going to take your 1.5 million divided by 5, multiply by 6, because that's our formula that we use to get our net replacement cost at the beginning of the year. And that will be the net replacement cost that we have, which will be 1.8 million, right? It's 1.5 divided by 5 times 6 is 1.8. And you will do your revaluation based on that amount, because they've said that the depreciation is based on the most recent revalued amount. So they'll never just tell you we accounted for the revaluation at the beginning of the year. They'll tell it to you in an indirect way like that, right? And then you will do your accounting for your net realizable value based on the 1.8 at the beginning of the year.
Sorry.
Mm-hmm.
Wouldn't it be easier to think of it this way? I've at the end of the year it's 1.5, and in this 5 years remaining useful life, then it means depreciation going forward would be 300,000. Then it means it's 1.5 after it has been depreciated by 300. So before it was depreciated, then it would be this 1.5 and the 3,000.
That's effectively it.
I don't know if I'm making sense.
No, you're making perfect sense. That's exactly it, actually. You know, maybe in a simpler way of explaining it, but that's basically it. So yeah, you can look at it from that aspect as well. That makes it easier for you guys to understand. But you guys need to show the calculation, though. You guys need to come to the net replacement cost at the beginning of the year and show that this was the 1.8. Because remember, when you do your revaluation now is going to be accounted for at the beginning of the year, right? Because they said depreciation for the year is based on the most recent revalued amounts or recent estimates. So everything is based now, it's going to happen at the beginning of the year. And you would then reevaluate the 1.8 million at the beginning of the year. So your revaluation wouldn't be the 1.5. It would be based on the 1.8. Does that make sense? Because you're taking it back to the beginning of the year. But if it doesn't make sense, what I'll do is I'll create an example for this later during the day. And then and then you guys do it that way. But these are calculations you guys need to do. You're going to score marks in it. Because this is, the aspects where you guys get lost. Now, here's the thing.
The calculation for the last time. Sorry.
The calculation for the last time. Okay, so like I said, you'll take your net replacement cost at the end of the year. You'll divide it by the remaining useful life at the end of the year. You'll multiply it by the remaining useful life at the beginning of the year, and that will give you your net replacement cost at the beginning of the year. And you will use that as your revalued amount, and you'll do your revaluation journal based on that. Okay. So that's that in a nutshell, right? Now, let's, yeah.
Isn't it the 6 was the whole useful life of the asset, or to somehow it will be the remaining at the beginning? They won't specify, or is it remaining at the beginning, or was it the actual useful life? They won't. We have to read and pick it up, ne?
Yeah, they'll never ever tell you. So they'll give you the total useful life of the assets on the date that it was purchased, and then you'll have to do this on your own and sort of like figure it out. That's So what I suggest is what I used to do. That's why I say they're making it so difficult that they're not allowing you guys to have your question papers printed out. Because what I used to do is I used to do all of this on the question paper, sort of like draw a timeline and say, okay, here's the beginning of the reporting period. What is my remaining useful life for the asset? The end of my reporting period, what is the remaining useful life of my asset? It makes it so much simpler. But just do that during your reading time. So whenever you have an asset, any asset, always just, make note of what the useful life of that asset is in total, what the expired useful life is, because that will help you calculate your accumulated depreciation, what the remaining useful life is as at the beginning of the year, what the remaining useful life is as at the end of the year. Okay. That 4 pieces of information should be with you for every single asset. You should know that, right? Now, what happens if you get stuck on this calculation? Let's say you need to get to your revalued amount, and now it's all gross replacement costs, net replacement costs. You don't know what's going on. You really, really confused, and because it look like right now we're doing it in the class, it's a bit simpler, but obviously under exam pressure and exam conditions, it looks very different. It looks like, something you've never done. I would say that, you can then assume an amount, it's fine, but make an amount that makes sense. So obviously, if they give you the gross replacement cost and you're going to assume an amount for your net replacement cost, is your net replacement cost is a depreciated gross replacement cost. It can never be more than your gross replacement cost. So let's say they gave you 2 million as gross replacement cost. Choose one amount that's less than that. Let's say 1.5 million, and just use that as your revalued amount. Okay, that's a worst case scenario, right? You'll just lose the marks for calculating your net replacement cost, but you'll get your carry forward marks when you take that into your calculation for your revalued amount and then your depreciation and stuff for the rest of the year. Okay, so don't leave anything blank, because I've come across things where students couldn't calculate the net replacement value and then they just left the question. But you can do everything else. I'm pretty sure you guys can still calculate depreciation. You guys know how to do a revaluation journal as well. That's like, it should be like clockwork by now, right? So those things are not marks that you should be leaving on the table, okay? Is there any other questions on this? Because I want to move forward from PPE because the time is like flying. What I will suggest very much is that you guys do go through your tutorial letter on this, because it does explain it in very good detail. If you work through, there's a class question or class exam, whatever they call it now. If you can do that question, you're fine. So go through your tutorial letters. I know you guys are going through TAT 107 right now, and that's all okay. But I'll tell you one thing: I never did TAT 107. My TAT 107 stayed in the plastic from. They sent me TAT 107 2 days after I wrote my accounting exam, so I never used that, and I was fine in the exam. So you don't need it. I don't know why they sent it, but it's what you pretty much get used to, but yeah, so you don't need your TAT 107, right? You don't need to start doing integrated questions before you've mastered the principle in isolation, okay? So I'll suggest that you guys that are at UNISA, but even you guys that are, studying at other institutions, because I've got a lot of you from Milpark, go through your individual questions on the topic and just do it step by step there, because if you can just do that on its own, it doesn't get more complicated in the exam. Okay, so just make sure that you can break it down, nitty-gritty. Unfortunately, because this class doesn't, allow for time to really do things. So only in the boot camps do we really sit in absolute detail and go through questions step by step. It's a bit difficult with all of this, because that's why the boot camp is so much longer as well. But once you've done the questions, it makes it easier. But what I'll do is that I would suggest that you guys go through that tutorial letter I don't know the TAT number, I think it's 103 or 104, and just do the class example question there. If you can do that one, you should be fine. If you struggle, then you're more than welcome to WhatsApp me and tell me, look, I'm struggling with it, and then I'll help you with it. But if you can do that, you are fine. You don't need to stress about funding. Okay. So that is your evaluation sets, as difficult as it really gets, right? Obviously, there's deferred tax to account for your assets on that. Now on PPE intangibles, I'm gonna prepare you guys a deferred tax summary, because at the end of the day, deferred tax, it's not difficult, but you guys don't have the amounts. You know, so in the first place, deferred tax is just pretty much your carrying amount minus your tax base times your tax rates. At this point, we're still getting to the point where we can even calculate the carrying amount, right? So your marks are in your carrying amount. Your marks are not in the deferred tax calc itself. Okay, so focus on getting your carrying amount right, because even if you get your deferred tax wrong, you know, it doesn't really cost you as many marks as what you think. It is one of the more difficult sections, or the more complicated one. So I will tell you this now. If at this point you don't know what's going on with your deferred tax, which I'm assuming a lot of you guys for PPE are stressed as hell right now, right? And if you are, please raise your hand or give me some reaction, right? I will prepare a summary for you guys on it, but what I'll tell you now is that I'd say you can draw a line in it. It's not going to cost you more than like 5 marks, okay? And you can make up that 5 marks by studying other sections and making up your marks there. Because if you're going to try and figure it out step by step now and all of that, look, when SSR on the cost model is very easy, right? If they on the revaluation model, you just need to know that you need to instead of your normal tax rate, you need to multiply by your CGT rate. Okay, you guys know that, right? Because the assumption is that the carrying amount will be recovered through sale rather than through use. Okay, I hope this is ringing a bell somewhere. And then there's obviously that whole things with the residual value, and then where one component is considered to be through cost, one is considered to be through residual, one, you know, I mean through use, one is considered to be through sale. I will give you guys a summary on that. Not today, it'll be tomorrow, right? But don't get overawed by that. Okay, right now, because to swat it all off and to remember it right now is gonna give you guys a bit of hell. So I would say that, you know, the worst case comes to worst, you guys can just calculate your depreciation. I mean, not a depreciation, your deferred tax on your assets like normal. Just multiply your carrying amount minus your tax base between it, because you're not going to get 0 for the question. I'll tell you that. And you know, move on from there, because I know some students that spent the whole week trying to figure this out, and then they came to me and they were like, I don't understand. I don't understand. I don't understand. I'm like, okay, why did you spend the whole week going through this? You should have, you know, come to me sooner or something. And okay, a lot of you guys didn't know I was financial counseling. Can you imagine a whole week of study time gone on one topic, which at this point she either does or does not still fully grasp? And that's just for, you know, if she gets the full marks, she's going to get like 3 marks more than what she would have gotten, compared to studying all our other sections where she would have maybe got like 30, 40 marks more. So use your study time wisely. Right now, you guys don't have the time to be, you know, getting everything perfect, right? So I will give you guys a summary on that, but I want to give you guys the more important topics to go through, right? So I'm going to put a pin in the PPE for now, and I'm going to go through the more important, you guys will get these slides. That's why I told a lot of you that message for the slides. I said I will send it through. I don't know why it hasn't come in yet, but that's not the most important thing. The most important thing in terms of the slides are actually, you know, your the detail that we do inside the class, because that's going to be what you guys need to know, right? So with intangible assets, this is very much similar to PPE, right? I'm going to do selected aspects of this. Okay, guys can see my screen, right? So I have summarized the requirements of Circular 32, right? Now, the only things that you guys need to notice, right, I'm going to put down on the thing, right? Intangible assets will almost always be tested on cost. How many of you, and honestly speaking, have ever seen an intangible asset here on the revaluation model in a question? Whichever university you've been in at. And this is important because it can come as a theory question. Anyone? Any of you ever noticed that whenever you do intangible assets, they're always on the cost model? Okay, so when you guys are doing your questions now, right, always notice, right, that your intangible assets 90% of, not 100% of the time, are on the cost model. You're always testing them on the cost model. Okay, so you guys must pay attention to this. Now when you guys start doing questions, you'll see when you go through them again, right? You'll see that they're typically on the cost model, right? They can be on the revaluation model. It's not that they can't be, but the thing is that with intangible assets, there's the underlying assumption, right, that the fair value of an intangible asset can't be determined reliably, right? And because of this, remember, one of the requirements to test to measure any assets on its fair value is that the asset must be, or the fair value of the asset must be able to be determined reliably. So the same rule applies for PPE as well, right? You can only carry an asset on the revaluation model if even with your investment properties, the same principle again, right? It needs to be that the asset has a fair value or a revaluation, basically a fair value that can be measured reliably. In the case of PPE and investment properties, that's usually not an issue, but with the intangible assets, that is, because one of the requirements for determining fair value reliably, right, is that the cost or value of Bitcoin will be a financial instrument, right? Not an intangible assets. So they must have told you that. I think that's what Bitcoin is, because it's a contract that you can receive cash. That's what it evidences, right? So it wouldn't fall under the ambit of an intangible assets. Okay. Because remember, what is an intangible assets? I can't understand why they would have classified it as an intangible asset, because IASB has issued a statement saying that your cryptos are classified as financial instruments, because remember, they're not non-monetary in nature. An intangible asset needs to be non-monetary in nature. So yeah, that's a weird one. It doesn't even meet the definition of an intangible asset because it's monetary in nature. So that's a weird one. But getting back to what I was saying, right? So I will stand by saying that this should have been a financial instrument, not an intangible asset. Okay. Anyway, because it can be used as currency. So how they came to that classification, God knows. But anyway, getting back to the point, right? Your intangible assets will almost exclusively be on cost because there's no active market for it. Okay, if you think about it, you have a website, there's no real active market where you're going to get a lot of your websites that's going to say, okay, this website is going to be, yes, you can get marketplaces online, but they're very difficult to get a fair value for that particular website because it would need to typically be valued by someone, because no two websites will be the same. Your software packages, same kind of things, they're not like that. They're not similar. You can't really say that the softwares are similar, and there won't be a whole bunch of it. If there's like software that's similar, it'll be maybe 2 or 3 packages at most. So there's no active market technically for intangible assets. Therefore, they will usually be classified or rather carried at cost. And that can be a question that will come as a theory question in terms of the classification of your intangibles. Like, the financial director, and I have seen a question like this where they've said that the financial director wants to move from cost to the revaluation method, and he wants to know why he can't. And then in the question, you just specify that, look, you know, you can either carry an asset on cost or revaluation or on the revaluation model, but before you can carry an asset on the revaluation model, there needs to be an active market. In the case of intangible assets, no active market exists, and then you make it applicable to the scenario. It was for software. Say this software does not have an active market. No active market exists. No fair value can be determined. Therefore, the revaluation method cannot be applied for the asset, and therefore it will just be carried at cost. So that is the biggest thing really that you need to know with your intangible assets. I don't make it more complicated than it needs to be. Those are the specific issues that get tested. They're not going to test you your basic things like your cost, okay, because that is something they can cover under PPE. So they don't need to repeat that. So they will basically look at that intangible assets from being tested there, or like how Thabiso mentioned in terms of classification. Right, again, I don't agree with Bitcoin being classified as an intangible asset. That makes zero sense, because what is an intangible asset? It's an identifiable non-monetary asset without physical substance. Bitcoin is currency, so it's monetary. So yeah, you know, it doesn't make sense that it wouldn't be that it would be an intangible asset. But those are the two types of questions you can get: a classification theory question, or it would be a revaluation or subsequent measurement one. The third one that would come in would be your website costs. Okay, they haven't tested website costs in a while, so I would say that website costs are something that you need to go through, right? So you guys can see this on my screen, and all you need to do for this one, right, is to really make reference to the standard itself. Standard itself makes all of this simple. Now, how are you going to lay out your answer? In the question paper, they're going to give you guys costs, you know, like this. They won't tell you the phase necessarily unless you want to make it very simple for you. But they're going to tell you, you know, the entity obtained a domain name, they did, you know, purchased hardware, they did this, they did that, and they'll give you the associated cost, right? And they won't deviate too much from this. They will stick very, very, very much to this, right? Now, your question is, how do you then determine whether you're going to calculate, whether you're going to capitalize it rather, or whether you're going to expense it? So you start off over here from point 7 or paragraph 7, okay? And you will say that an entity's website, right, that arises from the development or from development and is for internal or external access, is an internally generated intangible asset that is subject to the requirements of IS 38, right? This is a requirement. You must write that down when you are answering your theory question, okay? Now, your website can be for internal use or for external use. We'll get to that later on, okay? You don't have to worry about getting into it right now, okay? But this is a statement that you guys need to make sure that you've written down first, okay? Because the biggest thing is that, okay, it's an internally generated intangible asset. And in terms of internally generated intangible assets, that means there'll never be any goodwill on it and things like that as well. So that is another point that will come up that you need to just bear in mind. Okay, guys are with me so far?
Yes.
Okay, cool.
Yes, sir.
Okay, good. Now from here, you need to then say step 2 is to say whether the asset is for internal use or for external use. You must specify that, okay? Is the website for internal use or external use, okay? Is this in the example? It's in the standard, so you'll find it there in the standard. So it's in your handbook. So I want to go through the one in your handbook because then at least you guys can refer to it because then you have it with you, okay? So step 2 is the okay. And this is generally not very difficult to figure out, right? This basically, they will tell you in the question, okay, that, you know, we're going to use it for the purposes of making sales to customers or something like that, you know, that kind of thing. That is an external website, you know, like an e-commerce website, basically, right? An internal website will be like, you know, the intranet. So when you guys are at work, obviously there's, you know, your portal that you can log on and all of that stuff, and you else, and you can access your own stuff, you know. That is not for the purposes of generating revenue. That is now your internal you know, management and stuff like that. So those things, that is for internal access, right? So that is how you will be able to differentiate between the two. Okay, that's not too complicated, but you must state that. You have to state that in your answer. You can't be silent about that. You have to state that this website is for external use because you're not going to be using it to generate revenues, and it's going to be gaining future economic benefits from our customers, etc., etc. You know, something like that. If it's for internal use, you're just going to state the opposite. You know, you're going to say, look, it's for just for staff use, or, you know, for general admin and that kind of thing. Okay. And then you will state this. This is very important to write down. Okay. Any internal expenditure on the development and operation of an entity's own website shall be accounted for in accordance with IAS 38. Okay. Very, very, very important to write that down. Okay. You don't have to write the rest of it down. That's fine, because that's more guidance. But the principle is here on the first sentence. Okay. And now we're going to get more into the application part of it, right? So remember I said that there's going to be all those different costs that they're going to give us. And they won't tell us which phase it's going to be in. Sometimes they may, or sometimes they might not. What you need to do is, this is a good way of identifying which phase it's going to be in. Okay. So basically, let's say they've given us, you know, things saying, okay, no, we've done research on developing the website, yada, yada, yada. This is falling in the planning stage. So any expenditure incurred in this stage is automatically going to be recognized as an expense. Okay, so you do need to sort of start classifying or categorizing the expenditures. They will always give you a list of expenditures when it comes to your website costs, because that's what the standard itself says, website costs. It's pretty much in the name. So your costs are what get tested, you know, in simple terms, right? Then you would look at your costs that are here in your application and your infrastructural development stage, right? Now, this part here is the part that's important, okay? To the extent that the content is developed for the purposes other than to advertise or promote an entity's own products and services, are similar in nature to the development phase, right? So anything in the on the website, right, that is done as a catalog or kind of a thing like that, right? That's right is considered to be for advertising purposes. Okay, and if that is considered to be for advertising purposes, then those costs will be expensed. Okay, are you guys with me on that?
Yes, sir. I'm personally following, just that I'm a bit confused on which standard are you taking this into, since I also have problems with the use of my standards.
Okay, yeah, and that's why I'm trying to make use of the standards more than the slides, because You can take the standards with you in the test. You can't take the slides with you. So that's why I like using the standards, not the slides. Okay, so this is linking to IS 38. Okay.
Okay.
In terms of your intangible assets. Okay, so but it's not part of IS 38. It's a separate standard on its own called Circular 32. So when you go through your handbook, right, find this one. And this
Hi,
is what
Marco.
will, and that will talk to your website. Cause hi.
So
Okay,
I've
but
opened the.
where exactly is that? I'm busy looking through my standards to
Yeah.
find that.
No, it's
Yeah.
not
I'm
on the
so
standard
confused.
because it seems like it's cancelled. I've opened the IS 32. So I'm
I
not sure
also
if,
from the
and I'm not finding it on the part C book C2, unless if
I'm
maybe
also from there.
If
The
hello guys, hi guys.
Hi.
If you check on your standard, I think the IS standard, you must check it towards the end, and then you'll find IFRIC. After IFRIC, then you'll find the SIG side of it.
Okay.
towards the
Yeah.
end.
Yeah, towards the end of
They
the
usually are
IAS.
towards the end.
Oh yes.
Or
yeah,
IFRIC.
it's here.
Okay.
Yeah.
Thank
So
you.
you normally have your IFRSs, your IASs, your IFRICs, and then the circulars that come at the end, and then you sometimes get any expo. Well, they wouldn't really put the exposure drafts in here as yet, but yeah. So just check that because they do move it around from version to version. So you know, but look for it and flag it. I think flagging it
I found it.
is definitely a good idea for you right now. So yeah, just make sure that
Think you found it.
you found it. Okay, good.
Yes.
So that's a very important aspect. And the thing is, it's a very simple standard because literally you can look into it. They're only going to give you costs that are your, right? So what you'll do is you look at it, okay, which costs fall under the planning stage, automatically you'll say that this is an expense, right? That's all, right? You just classify it as an expense immediately, okay? And then you look at your you know, next phase, which is your application and development phase, you'll see the costs that are under there that they give you, and then you'll say whether this is an expense or it must be capitalized, right? Now, in most cases, these will end up being expensed because a lot of these costs are for promotional purposes. Okay, so in the case of like an external website, right, like an e-commerce website, right, that sometimes will be, you know, you must just see like, okay, can customers buy from you or they can't, right? Because sometimes, have you ever went onto a website and it's just the company website, but you can't buy anything? Right? It's just a company website. They say, who are we? What are we? Yada, yada, yada. That's it. Right? And they'll tell you what their products are and all of those things, but you can't buy from them. Let's take a restaurant, for example, right? Say we've got Nando's, for example. Now they've got their website over there. You'll go onto Nando's, they have their menu, all that, everything, right? But you can't order on their website, right? So that website, any costs there are not generating revenue, not directly anyway, right? But those will all be expensed because the purpose of that website is for what? It's like for information purposes. You know, it's just to have like a corporate identity on the web, basically. Does that make sense?
Yes.
Okay, cool. Right. But when it comes to your e-commerce websites, let's say now they've decided, okay, no, we're going to create a function on our website that allows for us to actually sell. You know, customers can come and they can log onto our website and they can order, you know, goods and things like that. They are not goods, food, right? Then those things, those costs will be capitalized. Okay. So your infrastructure and your development costs, right? So those will be capitalized. But, and there's a very big but on this, right? The nature of your expense, because this is infrastructure, right? Software infrastructure is fine. That can be, so if there's any programs or whatever, that we need to get as part of our infrastructure, that's intangible. That will be classified in terms of IAS 38. But let's say they said, okay, we need a separate server and all of that stuff, during this stage to host the website, and we had to buy a server and we had to buy, some or other hardware, right? Any hardware basically, right? That won't be classified in terms of IAS 38. That will be classified in terms of IAS 16. Guys are following me? Hello?
For me, I think I'm lost, to be honest.
Okay, so let me start from the beginning again, right? Planning stage, any expense automatically incurred, right? So any expenses that come in your planning stage, and they'll tell you like, doing research and evaluating, different types of websites you can get, all those other things, because they've given us a list of of costs that form under the planning stage, right? So that, like these costs, all of these costs automatically expensed. Okay, you happy on that? Then we get to the application and infrastructural development phase, right? All of these costs, it's going to depend, right? It's going to depend. Number one, and what will it depend on? It's going to depend on the purpose of the website. Okay. If the website is just for promotional activities, then all of these costs you expense. Straightforward expense, right? Go straight to your income statement. Right, so like I gave you that example with Nando's, you can't order on their website, right? It's only for showing that, hey, we have a website, or well, it's for more than that, but I mean, it's, for promotional or advertising purposes, you just expense it. If you can order on the website, you can, it has some functionality that allows you to place orders on the website, then obviously it's not for promotional purposes only, it's, to generate revenue, then you can capitalize the costs, okay? But why, provided they meet the recognition criteria, obviously, right? The cost must still be, the future economic benefits must still flow to the entity. Cost of value that can be measured reliably, that must still be there, right? But let's say now we can capitalize it. Now we need to see, okay, fine, some of these costs will be in terms of IAS 16 and some will be capitalized in terms of IAS 38. So obtaining a domain name is intangible. If you capitalize it, it's IAS 38. Purchasing and developing hardware will be in terms of IAS 16, not 38, okay? Because it's a tangible asset. Hardware is a tangible asset. With me? Operating software is intangible, so that will be in terms of IAS 38. Installing any applications and your stress testing, that will also form part of your IAS 38. Okay, because this relates to an intangible asset. Okay, so that's basically how you will look at those costs that come there, right? Then the costs that form part of our graphic design and development phase, right? So they'll tell us, the developer spent 50,000 Rand developing the web page or designing the web page or whatever, right? Thus, again, you will look at in terms of the purpose of the website, okay? If it's the purpose of the website is just for promotional activities, straightforward expense. If the purpose of the website is to generate revenue, we can place orders or something on it, then you will capitalize it, and you will capitalize this in terms of IAS 16. IS38. Okay. Content developments. These are the costs. Again, these are the only costs that they will already test you guys. They'll only give you costs like this, right? You must then again ask the question, is the website just for promotional activities or is it for, can I place orders? If it's only for promotional activities or advertising, then all of these costs, they're going to be straightforward expensed. If these costs are, if the website you can order and it is to generate revenue, then you will capitalize them. And these costs will be capitalized in terms of IS38 because it's just relating to content development. They're all intangible in nature. Okay, so this is why it's very important to know paragraph 2, because they'll always give you costs relating to these and you must see which phase it falls in. Planning phase is easy. You don't have to evaluate anything. Everything is automatically expensed. But any costs that form under these 3 headings, you need to say, okay, is the website the purpose for promotional activity? Can I, or not? In other words, a simple way of looking at it, can I place orders on this website or not as a customer, right? If you cannot place orders, or anyone actually, right, cannot place orders, that means it cannot generate revenue. So then all of these costs will be expensed. If it can generate revenue, right, you can place orders, then you will capitalize them in terms of IAS38, except for the hardware, because that is a tangible asset and that must be capitalized in terms of IAS16. Okay, does that make sense?
Yes, sir, it's clear now.
Okay. So this side here, these paragraphs, they're just giving you further information on how you would answer a theory question, because, these theory points are what you would write down. Okay, so you would say, when you are answering the theory question, you would say this, you would talk about that, and then you would apply. This is the theory points that are relevant. That's why I referred to it. Okay, so you don't have to read through it, and for the purposes of doing your calculations, you can actually then not spend so much of time on it. You can just follow what I said, and you can go to paragraph 2 and just evaluate and see where you're going to put it. But in terms of explaining it, or let's say you have to prepare a memorandum to the financial director and those kinds of things, right? The theory, the relevant theory is here. Okay. Guys are happy with that?
Yes.
Okay, I'll take that as a yes.
Sir,
Yeah.
when you say when we have to prepare a memo to the director, something like that, will it be also a question whereby we are being asked to determine whether we're going to expense or to capitalize the website costs? Because I'm a bit lost there.
Yeah, that is actually what you would be getting a question on. So they can actually ask you on exactly that point. Jidel asked, will I share the recording? Yes, the recording will be shared. So you guys can see that. You don't have to worry. And I know that we are like extending like way beyond our time. We still have leases to go through as well. But basically, this is a very large theory question that gets asked. The calculation part may or may not come in, but they would ask you, in terms of prepare a memorandum, explain to the financial director, which costs will be capitalized, which costs will be expensed, that kind of thing. I can, look at it, examples of some questions which might be good for you guys to go through for this. That might help you guys, but Abonga actually got a good point over there. All of this is in your standards, actually, so you guys can go through your standards. On my end, I mean, it's a little bit different because I've been using the ones from about 2 years ago is the one on this laptop, but it is in your standards, so make sure you use your standards fully, because there's a reason you can take it in, and like I said, you can take in this, you can't take in slides. So it makes sense to know your standard. That's what I've always felt. Okay. Do you guys want to take a break before we move on to Lisa's?
So can I ask something?
Yeah,
In-
sure.
In that summary, in that theory question, will it be wrong when I include these stages of website development to also explain to the directors? Because now I'm a bit confused. I understand these stages you were showing us so that we are able to do calculations. But when I'm answering a theory question, will I be wrong if I include those stages and probably explain the way you were explaining it? Maybe
Okay.
I can copy as they are from the textbook and then give a brief explanation on each of those stages.
Yeah, so what you can do is you can do it that way, right? So